Okay, so now we're going to go back and pick it up where we left off last time. We just barely started to touch on the topic of interest rate risk. This is now section two. And so we're going to introduce two key ideas here. We're going to look at the measures that are known as duration and convexity. And we're going to understand first how they're calculated, and secondly, what exactly do they tell us about interest rate risk. So, of course, interest rate risk is a huge deal in the bond markets because um, based on what we saw in section one, when interest rates rise in the economy, bond prices fall and vice versa. Why is that? Because the price of a bond is nothing but the present value of the remaining future cash flows, which mainly consists of coupons, but also the repayment of the face value at the maturity date. So the present value of the remaining cash flows. And so you remember the way present value is calculated, whenever interest rates rise, present value falls, and vice versa. So therefore, rising interest rates lower bond prices, and vice versa. Now, having said that, if you were to ever study an entire course of nothing but bond markets, it's a much more complex area of study than you might imagine. Just basic bonds are not terribly exciting. They're not terribly complicated, but it's gotten to the point where the bond markets are so sophisticated that there's a lot of different products available to us. And they have all kinds of interesting features that might surprise you. And, for the most part, they're designed to help the investors either manage their risk or maybe speculate on the future direction of interest rates in many different ways. But there do exist products, they're bonds, but they have very special features where this process is reversed. But, we won't get into that right now. But for the most part, most of the bonds in the market, virtually all of them, are adversely affected by rising interest rates. So right now, as the Fed has a lot of pressure put on it to lower rates, if you're a bondholder, you should be cheering because you know that once they do pull the trigger on interest rate cuts, that will add to the value of your portfolio. Okay, or if you're a Wall Street manager, it'll make your customers happier because you're making more money for them. Now, what's interesting about bonds is that although increasing rates will lower the price and vice versa, not all bonds are impacting uh, equally by changes in interest rates. In other words, some bonds are significantly affected by interest rate changes, and others not so much. And others, let's say, less so. Okay, in other words, there are some bonds where a change in interest rates will have fairly minimal impact on its price. And in other cases, there are bonds that would be dramatically affected by the same changes in interest rates. So what we need to do is understand how this works. And the way to do that is to define a measure of risk. And then we can use that to help us understand the differing impacts on different bonds. And then we, of course, can also try to understand what factors affect the amount of risk that's involved with bonds. Okay, so remember here, we're specifically talking about interest rate risk. There's other types of risks associated with bonds. We'll deal with those separately. Right now, we're focused exclusively on changes in interest rates and how they affect bonds. So the two measures of interest are known as duration and convexity. And I think we may have already started to talk about this last time. Duration itself was originally invented by an actuary named Frederick Macaulay in 1938. And he was interested in trying to make sure that whatever company he worked for had enough funds on hand to cover any outflows that might take place. So like, imagine you're working at an insurance company, and the biggest thing you got to worry about is if there's a lot of claims from the different policyholders at the same time, you want to make sure you've got plenty of money on hand to cover the claims. Otherwise, you're in trouble. So the business model for an insurance company is to take the premiums, invest them in something relatively safe, and hopefully the income from those investments will be enough to cover any payouts that you might have to make. If not, then there's going to be a problem. So it's important to understand in that case how sensitive the assets are that you're holding, in other words, the investments you've made, to interest rates compared to the liabilities that you have in the form of policies where there might be claims against the company. So Macaulay invented this measure. Later on, it was modified by to something called modified duration. Um, for what Macaulay was doing, his measure works just great. But for other areas, specifically managing bond portfolios, the modified duration is actually much more intuitive and easier to understand what it's actually telling us. So there, by the way, there are other measures of duration too. This is kind of the earliest ones, the most basic ones. There are others that are insanely complicated and they require an awful lot of information to implement them properly. So, but these are the standard ones. For the most part, these will do a good job, unless you need much more sophisticated information. All right, so this formula, now it's hard to tell by just by looking at it what this formula is telling us. So let's take a look at it really carefully. What's unusual about this formula is that we haven't seen this before, but what it's doing is it's weighting all the cash flows by the time at which they're received. So that's why you're seeing T here and N here. Remember how this works. T is the time at which the cash flows are received. It's an index. It runs from 1 to N. N is the maturity of the bond. So let's say, for example, this bond has annual coupon payments, and there are 30 left in the lifetime of the bond. N would be 30, and that's when you would receive the face value 30 years from now. In the meantime, you're going to get cash flows 1 through 30, and those are here. C is the constant coupon payment every period. That never changes. Okay. And so the R is the bond's yield to maturity. And that's the discount factor or the rate at which we discount the bond's cash flows. That number reflects several key factors, including the maturity of the bond and especially the credit rating of the bond. Okay, so in other words, you remember we had this discussion about credit risk. Except for bonds issued by the US federal government, which are known as treasury securities, they're all considered to be or to have some credit risk. Maybe not very much, but some credit risk. And the US government is in a unique position where if they don't have enough money to pay the treasury bills, treasury securities when they come due, they have other options that they can lean on. They can raise taxes, they can sell assets. There's a lot of ways they can raise money if they're really desperate enough to do that. So, you really don't have to worry about getting the cash flows from treasury securities. All the rest of them, in principle, have some credit risk. Even a company like Apple, in principle, could go out of business if everything goes wrong for them. So, how do we know how much credit risk a bond has associated with it? Rating agencies, which you may have heard of, such as Standard & Poor's and Moody's, provide bond ratings that reflect the creditworthiness of the issuer. Now, for corporations, now obviously a corporation can go out of business. No company lasts forever. So, you have to be aware that there's always going to be a bit of risk. So, there are AAA companies rated by Standard & Poor's that no longer exist. So nothing's guaranteed. So what you need to be able to do is look at those credit ratings and make up your mind if you are able to justify taking on that much risk. Now, of course, in return, the ones with the highest credit rating, risk rather, are going to have the highest yield to maturity. Okay, so in other words, the yield to maturity, of a bond. It's a very complicated concept. Is approximately equal to the rate of return to the owner, although not exactly, because in order for it to be exactly the same, there are many strong assumptions that have to be met. It's approximately equal to the return to the bondholder. Now, where do your returns come from with a bond? Well, the bond issuer will pay coupons. And if they don't, of course, they would be hauled into bankruptcy court to the bondholder. And that's the main source of income. But another way in which we can make money with bonds is this. If a bond is purchased when it is first issued, the price equals the face value of the bond. All right. At maturity, the bond is redeemed for its face value. In other words, you buy the bond when it's first issued, you pay the face value, which is probably $1,000. Then for the rest of the lifetime of the bond, you collect those coupon payments, and then on the maturity date, you should be getting your $1,000 back. If the bond is purchased after it is first issued, due to fluctuations in the market, by interest rates, I mean, let me add that in here. Interest rate fluctuations, the price of the bond is likely to be different from face value. Okay, if rates have risen since the bond was first issued, the bond's price will be lower than the face value. If the investor buys this bond and holds it to maturity, he or she will receive the full face value at maturity. So the difference between the price that you paid for it and the face value would then represent a capital gain. Okay, so for example, if an investor is able to buy bond for $9.50 because rates have been rising since the bond was first issued, and then holds it to maturity and receives the face value of $1,000, then the capital gain is, of course, $50. Now, of course, on the other hand, it's possible that the opposite has happened if rates have fallen since the bond was issued. The price will be greater than the face value, and the investor would then earn a capital loss if they hold it to maturity. Or I should say, suffer, not earn, suffer a capital loss if the bond is held to maturity. All right, so let's say another quick example: if an investor pays 1020 for a bond and holds it to maturity, well then he or she will only receive $1,000 on the maturity date. And that means they'll be suffering a $20 capital loss. So, in other words, as far as income from a bond goes, so the potential sources of income of a bond fall into really three basic categories. Number one, coupons. Okay. So the interest you get. Number two, capital gains or losses. Now, here's something that is implied by the pricing model that we use to price bonds. Reinvestment income from the coupons. So in other words, that the information you get out of a bond pricing model is based on the assumption that you're taking the coupons and reinvesting them at the same rate of interest. In other words, you're reinvesting them and earning a rate of return equal to the yield to maturity. Okay. So if the bond is held to maturity and the coupons are reinvested at the yield to maturity, meaning that your rate of return is the yield to maturity, and the yield will be the actual rate of return to the bond. Otherwise, two rates will be somewhat different. Not radically different, but different. So in other words, if let's say you have a bond with a yield to maturity of 8%, and some of these assumptions are false, you might end up with an actual return of, let's say, 7.92 or 8.04, depending on what happened with the reinvestment income. Okay. So the yield to maturity can be thought of as approximately the rate of return to the bond. But more formally, the yield to maturity is the unique rate of interest or discount rate at which the present value of the bond's cash flows oops, exactly matches the bond's market price. Okay? Remember the price yield curve that we identified earlier. This is the convex function where the first derivative is negative, the second derivative is positive. And so because of that, that means and also because if you notice, it is a smooth continuous function, and it is in fact monotonically decreasing. Notice there can't be any points along that curve where an increase in yield raises the price. That it's not mathematically possible. All right. So the function is monotonically decreasing, which implies the existence of an inverse. And how do you find that inverse? Well, we're going to see how that works, but the root finding techniques we saw last time can be used to do this. So if you know the price, that uniquely identifies the yield. If you know the yield, that uniquely identifies the price. So it goes both ways. Okay. So the yield is this number here at which the observed market price equals the present value of your bond's cash flows. Okay, so it's a very interesting idea. Sometimes, if you've heard this phrase before in another class, the yield is sometimes known as the bond's internal rate of return. Now, the unfortunate reality is we don't have the ability to actually do the inverting ourselves. So there's a lot of complications here, but basically in a nutshell, the yield and the price are related in the way you're seeing here. And we do know that there is an inverse. It exists because this function is monotonic. Okay. So anyway, back to duration. What you're seeing here is that basically it's the time weighted. It's kind of hard to explain this in English. This is one of the reasons why we normally use the modified duration for actually measuring the risk of bonds. Remember, this measure was originally intended for looking at the relationship between the sensitivity of financial institutions, assets and liabilities. But you can think of it as the time weighted average uh, until the cash flows are all received. And so, in fact, you often would see in books that try to explain how this works, it's like a little seesaw. Let me see if I can remember how this works. They would put like, here's the big seesaw. These are the cash flows. This is a fulcrum. And then, yeah, it would look something like that. I mean, this point, this is the Macaulay duration right here. But again, it's a little tricky to interpret in terms of English. And again, this is one reason why you would never see a bond portfolio manager on Wall Street using Macaulay duration. Instead, he would be leaning on modified duration because modified duration is just a derivative. That's literally all that it is. Okay. So that's the beauty of it. It's very easy to make sense out of it. This one, but it's a starting point. It's a good starting point. Okay. And then, of course, over here, divided by the price. So you're scaling all of this to the price of the bond. So the number itself can be compared directly to other bonds in the market. And the way it works is that the longer the duration or the larger the duration, the more sensitive the bond's price is to changes in yields. Okay. By the way, sometimes we say interest rates here, sometimes we say yields. It's assumed here, and this is normally a common assumption. We're basically assuming that all interest rates in the economy, and there's many of them, like the rate of interest on being charged for a mortgage, let's say, or for a car loan or for credit cards or all kinds of interest rates. We're assuming all rates in the economy are highly correlated with each other, so that an impact on short-term rates, will have a corresponding change or impact on long-term rates. So in other words, you can think of all rates as moving together up and down and up and down. It's not exactly true, but it's a pretty good approximation. And in fact, it's interesting about that because if you know how they're always talking about the Fed in the news. The Federal Reserve System is the central bank of the United States. They're the ones who decide what to do about interest rates. Right now, there's a lot of fighting between Trump and Powell about whether to lower rates or not. The thing is about the Fed is the Fed only has indirect control of a rate of an overnight rate known as the federal funds rate. Now, the federal funds rate is the rate that banks charge each other for overnight loans. Sometimes it's just called simply the Fed funds rate. The federal funds rate, or often known as the Fed funds rate, is the rate that banks charge each other for overnight loans. Now, why are they borrowing from each other? Well, I mean, you can imagine that like there's going to be times when a bank needs to make a payment of some kind and people with the money have not made their payments yet. And so the bank is like, well, what do we do now? We've got money coming in tomorrow, but we have a bill that's due today. So they'll go to another bank and just say, listen, could you lend us $1 million overnight? We'll pay you back tomorrow. It happens all the time. They do this all the time. And they do charge interest, although it's not very much, especially since it's overnight. But that's what this refers to. Now, the Fed doesn't set this rate at all. What they set is a target. If the rate drifts out away from the target, then they step in and they will either increase or decrease the money supply to get that Fed funds rate target back where they want it to be. But anyway, but in spite of this, the Fed's actions affect all interest rates in the economy, ranging from the very short-term rates to long-term rates, like mortgage rates. So it's kind of interesting how like all they have to do is, tinker with the Fed funds rate target, and the whole range of interest rates in the economy will react to it. So the Fed, by lowering rates, what they're doing is they're making it easier for everyone to borrow so that they will hopefully do exactly that and they will stimulate the economy. And I think the Fed is going to they're probably going to move in September. They don't want to move now. They're worried that inflation is much better than it's been, but it's still not quite where they want to see it. Plus, I don't think they want to give Trump the satisfaction. If he's going to bully them, they're going to say, listen, no, we're not going to be bullied by you. So it's kind of a headbutting thing. But anyway, yeah, but sooner or later they have to make their move because like even today, you probably saw that year to year CPI was only 2.7%, which is not very high above their target, which is 2%. But we'll see how it goes. Okay. Anyway, so oh, here we go. Oh, an example. Perfect. This is exactly what we want. Now, by the way, something like this, you're probably better off doing it in a spreadsheet than trying to do it with a calculator because it's a lot of work for a calculator. So I put together, I think this is the right example. Let me see. The spreadsheet, it's called Duration Examples. And maybe it's here, maybe it's not. Let's see. So anyway, what do we know? The bond has 4 years to maturity. And by the way, that could mean a lot of things. It could mean that this was a 30-year bond issued 26 years ago. It could be it was a 10-year bond issued 6 years ago. All that matters now is that it's now a 4-year bond. The coupon is $70 per year. The face value is 1,000, and the current market price is $960. If I buy this bond, by the way, that means I'll make and hold it to maturity. I'll get a $40 coupon. I'm sorry, $40 capital gain. What am I saying? The yield to maturity is 8.21%. The Macaulay duration is calculated by plugging in these numbers. No, I guess this is not the right example. Oh, I think it's this one because you can see, yeah, this is it. We've got 4 years of coupons. In the last year, you also get your face value back. So you notice in year 4, the cash flow is 1,007. You also know that the yield is 8.21%. So the present value that you need for this formula will be coming from that 8.21%. And then you also know that, no, that's all you need. All right, good. So the formula is here. So basically what's happening here is that in this column, these are the present values of the cash flows, which basically means what you would, let me write these in here. No, it's what you would have without the T. The T is the time element. And then you also have this one. So when you add the T here, these become time-weighted cash flows. And in other words, what you've got here is the numerator of your formula. Well, actually, I shouldn't say the numerator, because the way I've written it, it's all of this times 1/p. But I mean, that's essentially what you're doing. Everything to the right of that summation sign is, you can think of as the numerator, and p, which is nothing but the market price of your bond, is the denominator. So if you look in this column, you'll see that the present values are calculated by taking the cash flow divided by 1 plus the yield. The exponent equals the year in which I received that cash flow. So you notice it goes from A4 to A5 to A6 to A7. So in other words, the exponents are 1, 2, 3, and 4. And then over here, all I'm doing is multiplying those results by T. Right. So in other words, each one you've got A1, A4 rather, times C4 all the way down. Then you add them up. So here is the denominator, or the price of the bond, and here's the time-weighted cash flows. That ratio is what you're seeing right here, 3.62 years. That's the Macaulay duration of this bond. Now, again, remember, the way this is set up, the higher the Macaulay duration, the more sensitive the bond is to changes in interest rates. So now it turns out that the modified duration can be done two equivalent ways. You can either, if you already know the Macaulay duration, well, what you're seeing here is a clue. The Macaulay duration is what is that. Let me put this into the notes real fast so you can see the connection. You can think of it equivalently as negative 1 plus R is the yield, dp dr times 1/p. Okay. Now, by the way, if you notice there's a negative sign here, the reason why that's there is because dp dr is the slope of the price yield curve. If you let R be the yield to maturity, then that's the price yield curve, is the slope of the price yield curve, which we know is negative. So if you notice, by putting a negative here on the outside there, the extra negative in this formula ensures that the result of this calculation will be positive. Why are we doing this? Well, this is not an uncommon thing in finance or in the sciences. Negative numbers are awkward to deal with. They sometimes confuse people, especially when you have to think about what is an increase and what is a decrease. So the negative sign ensures that the Macaulay duration will always be shown as a positive number. Because ultimately, all we care about is the magnitude of this number anyway. So we might as well just make it more convenient and let it be positive. Okay. So modified duration, as it turns out, is we're going to, in this setup, we're going to use just plain D. Okay. Every book is different. We have to keep her on that. This would be Hull's notation. So anyway, this leads us to the following conclusion. If I already know the Macaulay duration, I don't have to do a whole lot of work for the modified duration because, as you can see, this implies that Dmac is negative 1 plus R times D. Oh my God. Well, actually, we don't need that negative here, do we? Because they're, yeah, that's right. Um, they cancel each other out. So ultimately, the bottom line is here. The modified duration D is D mac over 1 plus R. It couldn't be a whole lot simpler. And yet, in spite of that small change, the interpretation is so much cleaner. It's so much easier to understand what this is. Um, it's the sensitivity of the price or the slope of the price yield curve. We divide it by the price so that we can compare all bonds in the economy on an equal footing. Otherwise, the ones with larger face values would appear to be more sensitive when they're not really. So that's why we strip out the price, because this way we can directly compare the two. Now, in general terms, the duration measure, either one, the modified duration and the Macaulay duration, are bounded from above by the maturity of the. Okay, so if you notice with this one on the spreadsheet, we've got both of them here. Okay, so I went ahead and just simply divided by 1 plus R for the yield to maturity to go from Macaulay to modified. This is a 4-year bond. If you notice, both of these are somewhat less than 4. So the Macaulay duration of the zero coupon bond exactly equals the maturity of the bond for all of their cases, both Macaulay and modified durations are strictly less than the maturity of the bond. Okay, so that way we have a sense of what it's supposed to look like. Now, for longer maturity bonds, the duration measures can be significantly lower than the maturity of the bond. For example, a 30-year bond, depending on its other features, might have a duration, modified or Macaulay, it doesn't matter, 15, let's say. So in other words, as the time goes by, the duration becomes a smaller and smaller percentage of the maturity. And of course, the higher the duration, the more sensitive is the bond's price to changes in rates. So long duration means higher risk. That's the bottom line. Okay. Plus, this number gives you the exact amount by which you would expect the bond's price to change if yields do change by a specific amount. Okay. Now, in the slides, not the slides, in the spreadsheet, what we did here was say, well, listen, what happens if there's a yield change? Now, if you remember, we once before discussed this. There's a measure of interest rates that is used very heavily in the financial sector, which is called basis points. So a 1%, which is decimally equivalent to 0.01, is equivalent to 100 basis points. 0.1%, which is 0.001, is 10 basis points, and 0.01%, 0.0001 is 1 basis point. And of course, that's because using percentages can be very ambiguous. Basis points are not ambiguous. You know exactly what's meant. So here, in this example, what I've done is I said, listen, what would happen to this bond if the yield goes up by 1 basis point? So if the original yield was 8.21%, what does that do to the yield? So for example, if a bond has a yield of 8.21% or 0.0821, an increase to 0.0822 is a 1 basis point increase. All right. And of course, that also means increase to 0.0820 is a 1 basis point decrease. So why is this important? Well, the risk measures that we're looking at, that we are considering, are highly accurate when interest rate changes are very small. They become less accurate when the changes in interest rates are higher. Now, why is this happening? Well, because duration is a linear measure. Okay, it is being used to approximate changes in a nonlinear function. Let me show you a quick example of what I mean by that. So let's say we're right here at 8.21%. So the duration is basically the scaled slope of this curve, the slope adjusted for the price of the bond. So we can think of it as this. And by the way, this is modified duration. So if the yield only goes up to, let's say, 8.22%, the difference between the price yield curve and the straight line is very, very minimal. I mean, they're practically the same thing. But if I suddenly have a huge increase in 9, let's say, the difference between the actual new price and that predicted by duration, that's a big difference. Okay, so this is the actual, this is predicted. So when the change is that big, that really does distort our duration results. It's seriously understating the new price of the bond. Okay, and it cuts in both directions. If I do the same thing down here, you can see the problem there too. So the duration measure is linear. The price yield curve is convex. So, by the way, later on we'll see that the duration and convexity measures, I didn't mention this before, are simply the first two terms of a Taylor series that's used to approximate the price yield curve. We'll get back to that later on. Okay. But anyway, so the smaller change in yield, the more accurate is the duration measure. And this is true for both types, both Macaulay and modified. Now you can figure it out yourself. Look at this spreadsheet. Let's see. What I did here was this. You can see I've got these two changes. Actually, no, these came from a formula. Let me show you what this is all about. No, that's the convexity thing. We'll get back to that later. It's an alternative way of proving that a function is convex. So since modifying duration looks like this, d equals minus dp dr times one over p. Now, when we're actually calculating this, we can't actually use differential. So we normally rewrite this as, sorry, we normally use deltas to represent small changes instead of instantaneous changes, which you get with differentials. Okay. All right. So I said it right there. Those are differentials. In practice, in order to calculate the duration like this or its approximate impact, we're going to write this as negative delta P, delta R times 1 over. Now, I can do a couple of interesting things with this. First, imagine that I'm interested in which depend on the price of a bond due to a given change in R. I can rearrange this algebraically and end up with this. Okay, so all I do is multiply both sides by negative d delta r p. The negative is important here because it shows us, reminds us that delta p and d are going in opposite directions. Or I'm sorry, not d, but d delta r. So they have to go in opposite directions. That's why the negative needs to be in here. And then, so this is the dollar change. The percentage change would be this. All right. So we can calculate the dollar change, the predicted dollar change, and the predicted percentage change. So that's what I did in the spreadsheet, using 1 basis point as the change in R, delta R. So this is the predicted, and the formulas are right here. What about the actual? Well, the price is 960 right now, when the yield is 8.21%. So all we have to do to see the impact on the price, the actual impact, not the approximation, would be to go to the top here. Actually, let me fix that one more time here. And actually change it. Let's see what happens. When it changes to 0.0822. Yes, I'm assuming in this, you notice how the changes in price and percentage change are negative. So that implies that I'm looking for a 1 basis point increase in the yield. The price drops, as you can see. That's interesting. Oh, actually, I just realized, you know what happened here? This was a rounded, okay. This number was rounded. This is the actual correct value of the price. It's 960.11. So let me make that change here. So when this is exactly 8.21%, which it is now, the price is actually 960.11. Okay. I didn't notice that there was all those extra digits in there. I want it to be precisely 8.21%. Otherwise, this part will look a lot less accurate than it really is. So if I raise that to 8.22, what will be the new price? 959.79. And the difference between the two is 32 cents. Not bad. I mean, you can see these are not exactly right, but it's pretty close. All right, it's not bad. Well, it's understood that it's never going to be perfect, but the closer we can get, the better. Now, if we tried to change it to a preposterously large number, like if I jumped it up by 1 full percent, the approximation wouldn't be very good at all. So really, these measures are best when we have really small changes. And I mean 1 basis point kind of changes. After that, the approximation does start to worsen. All right. So now, yeah, this is the proof. If you want to use geometry, this is how you prove that a function is convex. I think it's interesting, but we can skip over this for now. Now, by the way, what you could do is actually differentiate this function with respect to r. I actually went ahead and did that. It's a lot of work, but it was worth it. So you can see the first derivative of this pricing function is guaranteed to be negative, which is what we'd expect. And then the second derivative is guaranteed to be positive. And in fact, if you wanted to, you could actually use these two functions, these two derivatives, that is, to come up with the convexity measure and the duration measure instead of what we were just doing. I have a feeling this would be a lot more work, though. All right. Anyway, so this is where these just came from. Okay, so we've already seen how this works. Now, convexity is a second order measure. Think of it as a second order approximation to the price yield curve. Like I was starting to say before, it's equivalent to a Taylor series. I think I have the actual, it's in here somewhere. I definitely put it in here. You can see how it lines up with the Taylor series. And we'll get to that. But convexity is basically the sensitivity of the duration itself to changes in yields. Okay, in other words, what happens to the duration? So, I mean, intuitively, let's take a quick look at this price yield curve. So what in the world am I showing you here? Well, um, right now, all I'm showing you is that when yields are low, the duration measure is relatively high. And again, now in these contexts, we're going to be using modified duration. If I forget to specify, it'll be modified duration unless I say otherwise. So the modified duration will be high, relatively high, I guess. And you can see why the slope is very, very steep. But when yields are high, the modified duration will be relatively low. So the duration itself is not a constant. It changes according to where we are on the price yield curve. So the convexity measure shows how sensitive modified duration is to the yield. So let me show you a couple of more examples here so you can see more about this. Let's say I have these two bonds. The difference between the two is that the first curve has a very pronounced curve to it. It is extremely convex, let's put it that way. The second one is convex too, technically, but not, it's hardly noticeable. It's almost linear. So what that means that is in the first case, we have a very high convexity. And you can see that the duration is extremely sensitive, meaning the slopes, this curve, to changes in yield. Even a small change in yield could cause the duration to change quite considerably. And that makes it difficult, by the way, to plan out hedging strategies. Whereas over here, we have very low convexity. And you can probably guess the difference between these 2 points is very minimal. Okay. So here, the duration is not very sensitive to changes in rates. Well, all right. I didn't plan this as well as I could have. On the left, the duration is extremely sensitive. On the right, so that means that the complexity measure that we're about to introduce is very high for the bond on the left and very low for the one on the right. Okay. And because it's the second derivative of the price yield curve, it is always positive. Okay, the duration is actually negative, but this is always positive. Okay, so ultimately, it's nothing but a second derivative scaled by the price of the bond. Okay, so you can see instead of dp dur times 1 over p, it's just it's second derivative of p over r with divided by p. Now, by the way, between the two of these, um, duration is far more important. It's a measure of bond price sensitivity, or I should say, its sensitivity to interest rate risk. Convexity is usually a very small number, not always. So its impact can be extremely minimal. In fact, in some cases, it's so small that it's hardly worth bothering with, because the difference between using and not using convexity can be like, it's a rounding error. Okay, so what we need to understand is what types of bonds have very high convexity levels and which ones are very low. And so in the case of the high ones, we might justify using both duration and convexity to measure our interest rate risk. For the simpler bonds with low convexities, we usually just use duration. Okay, well, there's other considerations too, which we'll discuss later on, but I just want to mention in passing here that a bond may contain any number of different types of what are called embedded options. These will have a huge impact on the duration of the bond. The ones we were looking at before, we were assuming there were no options. And therefore, this is, all of these results we obtained are perfectly valid. But and by the way, this is when you need more complicated versions of duration and convexity. When you have these bonds embedded in the contract that you're entering into as a bondholder, the options will definitely throw off these results. And so you'll need something much more sophisticated. So, but this is enough, I think, for now. I mean, we don't want to get too deeply into this since we really just got started. But so what we'll do is next time we'll start with the convexity and we'll see how that's calculated and how much of an impact it can have on the sensitivity of the bond's price, if any. Okay. So for now, I think we've got quite enough done for one night, and I will see you next time.